Hi, everyone. This is Rob Roy from eWoTrader.com, LA Wave Options. I'm happy to be with you today. I think I'm going to show you something that may be a little bit different, something that similar to what you just watched as far as analyzing with LA Wave and fib ratios. I've been trading for 27 years, started trading LA Wave back in 2001. I know there's a lot of commentary back and forth regarding LA Wave, but we have done something rather unique, I believe, which is infuse the LA Wave with AI. We have a 7-month track record doing that. And so I thought I would share some of those things with you today and some of the analysis. We on the chart have the 3-minute chart. Something weird just happened there in the market. But what you wanted to see is the fact that I like to trade zigzags. In the world of LA Wave, zigzag patterns are 3-wave corrective patterns. And you're also taught oftentimes don't trade the wave 3 within LA Wave. I believe that why would you want to avoid the strongest of all waves, whether or not you're a believer in LA Wave or not. I wasn't in the beginning. I thought it sounded like hocus pocus, and then it was proven to me in 2001. I've been trading with it ever since. So I'm showing a brand new platform that we have. It's in beta testing now. I'm going to show you how you can get this for free in a little bit. But what you're seeing on your screen right here, the ABCs, that's the zigzag pattern. So it's just a 3-wave pattern. So if you want to trade intraday, and I'm on a 3-minute chart, I like to watch the market on a 3-minute chart. You can trade all the same things that I'm going to share with you on an intraday basis. So whether or not you're a end-of-day trader and you like the 2 to 3 days to 2 to 3 weeks, which is normally what we're looking for, or you want to apply all this stuff intraday, it works just as well. And you can see it labels the LA Wave pattern. Now, the key here that I want to show you is just like clockwork here. And this chart's been running live while the other presentation was going, watching this zigzag pattern move down. The B wave correction was at 43.5%, awfully close to 50%, which means you're looking for a 100% extension on the C wave. And look where we found support intraday today, right at the 100% extension. And once that happens, then you look for a retracement back to the upside, which is exactly what the market's doing. I kind of think this spike here is a bad data point from Refinitiv. That's who we get our data from. So I'm not sure that that's actual, but who knows what's happened in the last couple of minutes in the market. And maybe some Fed governor came out and said something, but I think that's probably a bad note. But right here, we are climbing back to the upside here, and we should make our way back to this B wave if indeed that C wave correction was over. That's what normally happens. So I'm going to turn this off and then take you to a daily chart of where we are with the S&P. And then I've got some other charts to share with you that I think everybody is asking about at this point in time. But right now on the SPY, on the daily chart now, we are in a wave 4 correction that is labeled, that just labeled a couple of days ago. And just a quick comment. There's a lot of different LA Wave softwares out there. There's a lot of them that are personal adaptations of LA Wave, if you will. This actual software is programmed exactly to the algorithm as Ralph Nelson Elliott wrote it. So there's no personal changes or adaptations whatsoever. So it's just the pure LA Wave. And you can see where we've come down to. And one of the interesting things, I think, and I'm a believer in this, that gaps get filled. We have AI data that shows us 94% of gaps get filled. You don't always know when they're going to get filled. That's the key. Sometimes they get filled rather quickly. Sometimes it takes some time, but we're right there filling this gap up that occurred back in mid-February. So right now we're at a 27, almost 28% correction in the markets. We all know what's going on in the markets. I'm sure you've heard it a bunch of times, so I don't need to rehash it. We're moving out based on the Fed fund futures on when the Fed may actually cut, if at all, this year, and that sent the market lower. So we are in a little bit of a correction. Now, one of the things that I like to look at are the moving averages. On your screen here, this lime green line is the 10-day moving average. The fuchsia colored line is the 30-day. I don't look for the 30-day moving average as any sort of support resistance. I look at that more from an idea of a cross between the 10 and the 30. And you can see that the 10-day moving average has crossed the 30-day. So for me, that's a warning signal that perhaps there's more correction to go here. But we've also broken the 50-day moving average, which is the royal blue line. And so when you have this bearish cross, and I got that from some ex-floor traders, I always joke that you really don't get a lot of information from current floor traders. You have to talk to people that are retired to find out what really goes on, because the ones that are still active don't really give you a whole lot of information as far as what's happening. But when you talk to ex-market makers, they do. I do a live recording, or excuse me, a free recording on YouTube every week, and I talk about this. And somebody said, I'm an ex-floor trader, and you're 100% right. That's one of the things that we looked at for potential change in trend. So the fact that the 10 has crossed the 30, and note that hasn't happened, and since it crossed to the upside back in November of last year, and then the 10 has stayed above the 30. But that cross there, I think, even though we're at an area of potential support here, at least short term, because we're a little overbought from the 10-day moving average. I also have a rule: no security in any time frame gets very far away from the 10-day moving average. So I'm a big believer in watching that, along with LA Wave, some of the other signals that you'll see as we talk about some of these charts and what's going on. I look forward to your questions and symbols that you may want to see as well. But that's where we are in the U.S. markets. I think we're going to be maybe trading a little sideways from this point in time. I don't see a catalyst for some sort of a big bounce other than maybe a reflex bounce to close that gap with the 10-day moving average until we get the PCE report. I believe that's on April 26th. That's the Fed's favorite inflation indicator, and we'll see how things play out until we move to that level. So some of the really cool things about what we do and what's a little bit different is we have infused this with AI. And you can see over on the software here, there's a button that says AI. So when you click on that, it brings you up each and every day the searches that are results from the AI data scientists that we have employed to create this for us. And as I said, we have a published 7-month plus track record. Now it gives a score. You can see that there's one symbol here, HDGE. So I thought I would go ahead and bring that one on just so you can get an idea of what it looks like. And you can see it gives you a target price. It also gives you a fail zone. People are always asking, well, where are your stops, etc. Not necessarily a big believer in physical stops, because if you've been trading and you've put in physical stops, how often has it happened to you to where you had a physical stop, you got stopped out of a trade, and then the stock turned and went the same direction you were expecting it to go right after you got stopped out? I think a lot of people can relate to that. And that's what happens so often. So I like mental stops. Go ahead and put them in physically if it hits your stop. So not only does the AI give you a target, it gives a rating here. And the score here is only 56, so we wouldn't do anything with this on the bullish side because we look for a rating of 75 or above before we're going to do anything with that. But then if it hits that target, then you're out. And if it comes down and hits this failed zone, assuming this would be one that you would enter, then that would be your stop. So you would get out at that point in time. You can also see that there's a bearish list as well. And all these are geared towards the wave 3. Now, the AI doesn't take into account Elliott wave. What it does is it takes stocks that have labeled the wave 3 on the first day, and then it goes through all the data points and gives you a strength rating of the likelihood that the targets are going to be hit. So you can see there's a number of bearish ones. We haven't had a whole lot of bearish ones for a while. Now they're starting to sneak up, but the ratings are still low. So the scores are still low, not enough to where we would actually want to enter one of these trades, but it certainly helps to take a look and see what's going on with these different rating stocks. And the excitement, I think, of maybe we start to get some bearish signals. And I say that kind of with a little reservation, because I know everybody makes more money when the market moves to the upside. We all have retirement accounts, IRAs, 401ks. So the majority of people make money when it moves to the upside. But we trade options. That's why our name is Elliott Wave Options. And so when the market moves to the downside, we all know the market moves down faster than it moves up. The old expression, market takes a stairway up and the elevator down. So when the market moves to the downside, you tend to put on trades a bit more often and take them off a bit earlier, and you can generate greater gains in a down market. We haven't really had the opportunity to do that since 2020, other than maybe a few select stocks that we've stayed away from. So that's the AI here. I'll tell you a bit more about that as we move in, but I did want to go through a few symbols that I think are kind of interesting for people at this point in time. So we'll take a look at TNX. I think rates are important. One of the things that I talk to our subscribers about all the time is you don't have to be an expert in the bond market, but if you want to be a really good equities trader, you probably ought to have a decent working knowledge of the bond market. Bond market is larger than the equities market. There's more money in there. It's viewed that there are really smart people in the bond market. And when we have this wave three here, and once again, I have the zigzag on the chart. So that's what it is. It's just an A wave impulse with a correction. We look for where the correction is in the B wave. In this case, it's awfully close to that 61.8% fib level, which is my favorite setup because it just works such a high percentage of the time. And that gives you the look at 100% extension. And you can see that rates have broken a little bit above that, backing off a little bit today. But when you come to this level, sometimes you go up to the next fib level. That's called an extended wave C. And you look for that within these wave threes because this move is so strong. And if we do move up to that 161.8% extension, then yikes, it's taking us up towards those highs on the 10-year, up around 5% that we had back in October, just before breaking down. I don't think that would be positive for the markets. I think the Qs have been hanging in there surprisingly well with rates, but we could be breaking down if indeed this wave three continues. We'll see how that trades out. So let's look at the moving average. You can see we're a little above that 10-day moving average here. So I think maybe rates calm down a little bit as we move in towards the end of the week. And then we'll have to see if they retrace. Oftentimes, based on the rules here with the zigzag patterns, if you're going to move to the extended level, and I just want to be clear that the 100% level is what was expected. It went there. But if you're going to move to an extended level, oftentimes you will come back and test the previous fib level first, which may mean a little bit of a pullback in rates before turning and moving back to the upside to hit that 161.8% extension. So I think perhaps rates calm here for a bit over the next several days, and we'll see if that allows some sort of a bid to come back into the equities markets, and then we can move higher from there, perhaps. GLD is another stock that I wanted to share with you. Everybody's been asking about gold because, wow, did it take off and run to the upside? Look at that move. And even though it's almost a vertical move, I don't really like vertical moves too much because when something moves vertically up, it often comes vertically back down. But you can see we kind of hugged the 10-day moving average all the way up. Now we're consolidating a bit here in the wave three on GLD. So maybe we need a little bit of a pause. Something else that I wanted to share with you is another one of the rules that I look for is note the separation between the 10 and the 50-day moving average. So it's the same rule where I said no security in any time frame gets too far from the 10-day moving average, and it works both ways, whether you get too far up or down. You can see we got a little bit above it here, so we came right back down to it. We got above it right here at the wave three high, came back down to it. That happens like clockwork. But also when you start to see this kind of separation between the 10 and the 50-day moving average, that usually means that you're also perhaps a little short-term overbought and a little bit of at least consolidation, if not pullback, is in order. So it looks to me like maybe that big move in gold needs to pause for a bit here and allow that gap to close between the 10-day and the 50-day moving average. It's been a heck of a run in GLD. We had some alerts in the gold sector for our subscribers, but then we took them off. And then you look back at it and you say, oh gosh, maybe we took them off a little bit too soon. But once again, when you have a profit, be happy with the profit. That's something that experience teaches you, because if you second guess yourself, you'll go crazy. So if you were happy with the profit when you took it off, don't go back and second guess yourself, because that doesn't solve anything other than heartbreak. And then Tesla. I've been talking about Tesla for quite some time in the shows that I do, and 160 was the level here that we needed to hold. We needed to hold 160, and we haven't. We've broken below that 160 level. Now, the wave 5 is showing that we could potentially go down to 125. I think that's probably highly likely. I don't know where the catalyst is. I know a lot of people love this stock, but I don't know where the catalyst is for Tesla to turn and move back to the upside from here. So if I condense the chart a bit, you can see where if we break this 160 level, the next level is down here, and that's at 100. And other than that, wave 5 forecast at 125, I don't really see much to stop us from going down towards this 100 level. And that's right there is the 100 level. So breaking below this 160, there was just a big move to the upside here. So there's no resistance in the way. So if we come down here towards that midpoint of the wave 5 forecast, I think we probably work all the way down towards that 100 level. So I don't really have anything too positive to say about Tesla. And people get upset if you're not bullish on Tesla. It's been so loved for so long, but it looks like things are breaking down. Another stock that I get asked about quite often is Boeing. So if we talk about Boeing, that one did break also its level that it needed to hold, and that was in the 180 level. It needed to hold 180. I can remember back when it was around 200. We broke below 200. We came down to 180. We got a little bit of a reflex bounce because we got a little oversold there. And my comment was, what other negative headline can come out about Boeing? And sure enough, you probably have read what happened. I don't want to get into that kind of stuff, but there was more bad news. And so we broke below 180 on Boeing. We are in a wave 3 to the downside. We got a little bit oversold. So this is what normally happens when you get oversold. Either the stock goes sideways and consolidates and allows that 10-day moving average to catch up, or you get a little bit of a reflex bounce. So here we got so oversold, we got a reflex bounce higher. This time it looks like we're just kind of going sideways. It just seems like if you have a longer term view that at some point in time, Boeing's going to get their act together. But for the short term, it seems like people are pretty fed up with it. And the next real big support level for Boeing is, gosh, all the way down here around 125. So maybe we're not done going to the downside. There's the line on the lower left here. And as you can see, there's nothing in between. There's just a big gap there. There's no support to move that back to the upside, or at least stop the downward move. So once the 10-day moving average catches up, maybe there's more downside to go. Now we did break this major support at 180, so maybe we get a bounce back up to test the 180 level, or maybe we just start to kind of meander to the downside. But it just seems like nobody wants to touch Boeing right now, and that's been frustrating. I know a lot of people are in Boeing. They trade Boeing. A lot of people thought we were going to hold back here around 200 and made the comment that if we break 200, we're probably going to 180. And that's what happened. So now the concern is we've broken 180. Where do we go from here? So if we take a look at the chart of oil here, we'll be able to see that we are in an area of potential pause. It's not been too much fun for me driving. I drive a Hellcat, if you know what that is. Not the most fuel efficient vehicle to drive. And so this move higher in oil, I'm sure everybody's familiar with how when oil goes up, it seems to be reflected at the gas pump the next day. When oil goes back down, it takes weeks or months before we see the price come down. But isn't that interesting where the wave 3 here on the USO went right to where the wave 5 high was back in September. And that's kind of been a little bit of resistance. So we're pulling back a little bit on oil. The next level of support that I see here on oil is right around here in this area, maybe 77 and a half. 75 is always the big level of support resistance. Is where that wave 3 high was before we had the wave 4 correction and the move higher in the wave 5. So we kind of traded there, found it as resistance back in the last summer, and then support into the fall. We broke below it and we went up, tested that recent high, and we moved back down. I know a lot of people think oil is going to 100, and maybe it does, but at least we're getting a little bit of a short-term break here in the price of oil, and maybe we come down to 75 or at least the first level of 77 and a half, as I've noted. So happy to look at some other charts. In the meantime, I wanted to talk to you a little bit about the AI and what the AI has done and how it's changed the way I trade and the way we set things up. We do have these data scientists. They look at indicators like this that you can find on your own out there. If you have the computer power, if you have the brain power to create all these kinds of algorithms, then you can find that kind of data yourself. But they also use these things called regression clustering, random forest ensemble, and neural networks. Neural networks, I know what those are. That's where you give the AI a situation and the AI goes to solve it. And the situation we gave it is when a pattern moves into a new wave 3, what's the likelihood of it continuing it and where's it likely to go? And so the data scientists created all of these points. I have some search parameters that I sent them, and then I ask them, hey, can you share with me what you're doing? They don't share the algorithm, it's proprietary. They share the signals with us that I showed you on the screen, and they sent me all this stuff. And I was like, I have no idea what all that stuff means. The coding's along the top, but the basis here is that you look for where all of those clusters are. And so what they do is they go through and they analyze all these different pictures. Somebody said once it looks like an ultrasound picture. These are the 36 most common or most important correlations. And basically, it's analyzing these over 300 data points, and it does take into account fundamentals. So economic cycles, fundamentals are also included in there, as well as technicals. And then it goes to find, all right, where do the ones agree? And that's where the score comes from. And so it gives you a scoring of where you're likely to go from there. And this is how it's affected the trading. One of the things is, even though we're trading options that are a bit shorter term, my average length of trade in a directional trade, even in these zigzags, is about 50 days. And since we initiated the AI trading back in September of last year, it has cut the average trade time in half. We're under 24 days. So that's about the length of time that we're in. So as I said, we're not day traders, but we're 2 to 3 days, 2 to 3 weeks is what we're looking for, even though you can take all this information on an intraday basis, as I said, if you want. But that's a great help when you cut the time of your trades in less than half. And in addition to that, there was the average number of alerts we're sending out. And then with the AI, the number of alerts tripled. So we're sending out 3 times more alerts than we were before and being in them half the time. So that's pretty good double whammy there. And I said we have 7+ months of track record. We haven't had a losing month yet using these AI signals. That doesn't mean that we won't. You all know how trading is. Sometimes you're right, sometimes you're wrong. But those are the actual results based on sending out less than $500 at risk per alert that goes out. So no losing months yet. So April, we're to the plus side already. And I just wanted to share with you here. I believe this link will be put in the chat as well. But if you want to try it, you can try it for free. That's how positive we are on this, that you're going to like it. So you can sign up for it and you'll get the alert signals that we send out for free for 30 days. So go to that link, home.ewotrader.com/ewo-ai-trial, and you'll be able to get 30 days free. I'm on twice a week live where you can ask questions as well. So nothing to lose here. No credit card information needed. None of those things. It's just we're this confident that you'll like it if you give it a try. So that's the link to go ahead and give these AI signals a try. We're really excited about it. The opportunity to really have an extremely profitable 2024 after a really good end to last year of 2023. So I'm going to go back here to the screen. If there's some other stocks of interest that you're interested in, I'm happy to put those up and show what we're looking at here. Or I can just keep rambling on because I can talk forever regarding stocks of interest. Somebody wants SMCI, and I can understand that one. That one was certainly super micro has been a big mover. Now went into a bit of a triangle, and now we're trying to figure out which way it's going to break. This is my favorite breakout pattern, by the way. So when you look at this, when you have, some people call this a flag pattern. My first career out of college was as a golf pro. I was a golf pro for nearly 13 years, and then I've been trading for 27 years since that. It's the only two things I've ever done in my life. And so this kind of the old school flags that we used to have on the flagpoles, that's what it used to look like, where we had these triangular type formations. Other people view it as more rectangular when you have a flag pattern, so they would look at the line a little bit more this way. But when you have a vertical move that moves into a symmetrical triangle along this, it's gonna break out. And so one thing that I can say is that SMCI is going to break out, and it's going to break out significantly. So when you look at these corrective triangles, and that's another one of the corrective patterns within LE Wave, flat zigzags and triangles. I like the zigzags from a directional standpoint, but when you look at this from the triangle, what you do is you measure the mouth of the triangle. So where's the bottom, where's the top? And it's huge. It's about 500 points. And that's the move that you expect from the breakout at the point of the triangle. So it could be 500 points to the upside or to the downside. So I know everybody wants to know what direction is it going to go. But one of the things that Elliott wrote in his writings is that when you see a triangle, it trumps everything. So even though we're in a 5-wave pattern to the upside, and the Elliott wave pattern would lead you to believe that, hey, we're probably going to move to the upside. The fact that we're in a triangle, you have to respect that we could potentially move lower. Now, the last couple of days has been trying to sneak out of the upside of that trend line, and you could kind of draw it there. I like the most touches of the trend line. Drawing trend lines is not an exact science. So we're trying to sneak out today. And if rates calm down just a bit as we looked at the chart of the TNX, then perhaps that will give us the opportunity to have an upside breakout here and move higher. But the only thing that I can tell you for sure is that we're going to see a move. Now, notice that we came down and tested the 50-day moving average. All this consolidation that's occurred so far in April, right here on the top of the 50-day moving average, and it's a well-formed triangle. It's about as good as it looks, as good as you're going to get it to look on this setup. So with that, I wish I could tell you which direction it's going, but keep an eye on it. I like to do strangles. One of the claims of fame that I have was on strangles, not the typical one where you go one strike out of the money. I use strangles where you have the best delta gamma relationship dealing with the Greeks. Another thing, if you're going to be an options trader, you need to understand the Greeks. And so you can set those up around a 25 to 30 delta on the call and put, and that gives you mathematically the greatest acceleration depending on which direction it breaks. So for instance, if we had done, and it's going to be too expensive to do it here, but if you did a strangle on this and the stock breaks to the upside, what that delta gamma relationship gives you is that mathematically, as you move up, you're going to get the highest speed of the delta movement, or the option to the upside. In this case, the call would generate a gain as fast as mathematically possible. And then because we're placing the put down at that same point where the delta curve levels off, that option loses money as slow as mathematically possible. So you have one option making money as fast as mathematically possible, the other option losing money as slowly as mathematically possible, which gives you mathematically the greatest spread between the two. Now, that's if the stock breaks out. It still has to break out. It still has to move. A strangle needs it to move. You're buying a call, you're buying a put. So theta, time decay, is an enemy there, but it's set up, and somebody found out about that. And I got a book out on that strategy. I've written 3 books, so that was the first one. And I didn't seek out a publishing company. They called me. I don't know how they found out about it, but they did. And so if you had a lower dollar stock, that's the kind of a strategy that you could look to employ. And I think you'll find that it works a whole lot better than a straddle or even a normal strangle. Again, a normal strangle is one strike out of the money. We're going further than that to get that delta gamma relationship. So great question on SMCI. It is unbelievable, really, how well formed that triangle is. So I would be chomping at the bit if this was a lower dollar stock in order to put a strangle on here, but it's not. So we have to wait, watch for the directional breakout, and then trade it along those lines. So it's going to move. So let's see, we've got a number of other questions here. I get to as many of them as I can. CRM, so Salesforce, also kind of a blast from the past. They got a little bit quiet for a while and then really took off and started moving. You can see where we went to the wave 5, exactly where it was forecast to go. So we hit the midpoint exactly there and then consolidated. And that's what happens after a 5-wave pattern ends. It goes through consolidation and then figures out what it wants to do from there. So note that the wave 5 extended more than 100%. And when that happens, you don't look for, if you're familiar with Elliott wave rules, you don't look for a move back to the previous 4. You look for a 61.8% fib retracement. If the wave 5 extends less than 100%, then you look for a move back to the previous 4. So that's right where we are here on Salesforce. So we're trying to consolidate here right above that previous 3. So that's going to be right in that 61.8% fib corrective level. If we look at the moving averages, you can see that on the negative side, we do have that bearish cross on the 10-day cross and below the 30-day, but we're a tiny bit oversold. So we're going sideways here. And if we get a break in the market, if the market does go, and I think we're going to need 2 things. I think we're going to need rates to continue to calm down, and we're going to need that PCE report to come in tame. If the PCE report comes in hot on top of the last PPI CPI report, then we're probably in for more downside and all bets are off and we have to recalculate. But we're trying to figure out what's going to happen between now and that PCE report. And I think that barring any sort of more ugliness in the market or another surprise, as we got the other day with Israel coming out and saying that they were going to answer Iran's attack, that sent the markets down intraday. If you're watching that chart, as soon as that news came out, the market went down. So without any more war things or any other unexpected news, I think we might get a little bit of a bounce here on Salesforce, at least back to that 10-day moving average. And that probably brings us towards that April 26th date with the PCE report. If that report comes in tame, I think we could have some fuel for another move, another leg higher in the markets. But we need that to be tame, and we need rates to calm down. Those are double whammies to the market. So those are the things we'll be looking for there. But good chart to look at there on CRM. One of the things that I talk a lot about is the fact that people have different risk tolerances. So oftentimes when I'm doing analysis like this, I'll give an aggressive and a conservative analysis. So this is a good example of that. If you're really aggressive and you have speculative money, I think you could take a shot long here, at least to the bounce back up towards that 10-day moving average. So if I take a look with the crosshairs, that would bring you up to about 290. So a little bit of a bounce there that you could receive here on Salesforce. Now, if you're more conservative minded, you want it back above the 10-day moving average and more ideally back above the 50-day moving average before you go long. So you're just on pause and waiting. So yeah, I mean, we all you know what your own risk tolerance is. We all have our different ones, and so I feel like yeah, when I give two different uh, ratings like that, it helps people to do whatever they're comfortable with. So I see FedEx has been asked about. So let's take a look at the chart on FedEx, and doesn't look like we're currently in a five-wave pattern on FedEx. Sometimes stocks aren't in. I've taken it will label the ABC corrective patterns on there for you, but I've turned that off because the only one I'm really interested in is zigzags, and I draw them myself. There's a tool right here that you can draw zigzags with. So we've come down and we filled this gap. So what I would be looking for is where is that correction level? So I'll go ahead and use this zigzag tool here, and you can see there's where that first impulse was, and we're sitting right here on top of the 50-day moving average, was exactly a 50% corrective move. So I would be interested in that. And then we start looking up here, and there's the target range. We can go all the way up to potential 100% extension on FedEx. So if we can hold here, and this is a really good one. A question asked here, and once again, with the conservative, aggressive area, you can see that we traded through this area all through the end of last summer into the fall. Then we broke down. We had a run at the end of the year, which FedEx and UPS usually do. We all know why that is. We broke back down, and then we've moved higher here, and the gap up needed to be filled. It has, and we're sitting on not only a 50% B wave correction, but we're also sitting on that support level right here around 260 that occurred back in the time of the end of the fall. So once again, if you're aggressive minded, you could take a shot here. Or if you're more conservative, let it get back above the 10-day moving average. But you might feel a little more comfortable in this one because it, at least for now, is holding the 50-day, and the 50-day is sitting right on all that support. 50% correction and the support resistance level from last fall into the summer. So yeah, you could take a shot long here. Now the stop is easy. If we break below this level at 260, then you just get out. And the reason for that is you can see this move here from that 0 point where the zigzag started is down around 230, and there's nothing there. It went just almost in a perfect 45-degree angle up from that level up to the 260 range. So if you break below 260, then you're out. So that's where your mental stop would be in physical, but perhaps we get some sort of a bounce from here on FedEx. And I know that's a little counterintuitive with what the prices of oil have been doing, but perhaps that's why we've been going lower here. And if oil is going to give us a little bit of a break, like it looked like it might, then that could be a catalyst to move FedEx back to the upside. So interesting things along those lines. FCX, yeah, that's been a really good space to be in as well. Anything along the lines, gold, silver, copper, all those things, Freeport Mac brand. We had that big wave 3 run. It got a little vertical. And when I talk about these vertical moves, what I prefer is when you see a wave 3 move in a 45-degree angle. And when you move in a 45-degree angle, the reason that I like that is the corrective moves tend to be less severe. The more vertical the move is, and it's fun if you're in it, right? If you're in this, if you're in a bullish trade here and it's running vertically, that's great because IVs being infused into your call options, etc. All that works. But when you move more vertically, the corrective moves tend to be a bit more severe. than if you move in a 45-degree angle. So the fact that Freeport moved up, we're getting a little bit of a correction here. We're trying to hold right around this 10-day moving average, but I would suggest that perhaps we may be looking at Freeport coming down into some area more along the lines of here as far as a correction because of how vertical that move went. So I don't know if that's one of the things that you're interested in if you're looking long or short here. But we also have that separation between the 10 and the 50-day moving average. So this is suggesting that it's a bit overbought. I do like to look at the DMI as one of my favorite indicators to confirm. I'm a big believer that you should never rely on one technical indicator. I do believe in Elliott wave, but I would never trade only on Elliott wave. So now we have some confirming indicators, which I sent to the data scientists. So they've taken the DMI, the CCI, taken money flow, a few of the other confirming indicators, and all that stuff got moved into the AI and all those data points that they added. So they took all that, they supercharged it, they added over 300 more data points into it. And so that's what's created the kind of results that we've had since September, since we actually went live with that. Now, when you look at the DMI, you can see the ADX is rolling over. It's above the positive directional indicator. For those of you that may not be as familiar with the DMI, it was created by Wells Wilder, same guy that created RSI, relative strength. Most people are familiar with that, not as many people with the DMI, which I kind of like. But when you start to see this roll over, it's also kind of giving a signal that maybe this wave 3 run is over, or at least getting tired. We are trying to hold up here. You can see the little tiny bar there, but this with a separation between the 10 and the 50, I think this kind of goes along the line of gold, where maybe we don't get a big pullback, but at least some sort of consolidation, I think, is warranted. The one thing that the DMI tells you, it doesn't necessarily tell you when the ADX moves above this level of 40 and rolls over. It doesn't tell you that the move is over. It tells you the strongest part of the move is over. So it doesn't mean we can't go higher, but it's telling you that any move higher from here would be much weaker than this move from here to here. And so with that in mind, you would want to be a little bit cautious on any further move to the upside from there. And then keeping in mind the separation between the 10 and the 50-day moving average is getting a little extreme too. So perhaps on FCX, we're getting a little bit tired. I'll show you the link again. I see a lot of people are asking for the link. I'll go through and post that again. If there's not any more symbols, I've got plenty of other stocks that I can look at. Feel free to put them in the chat if you have something that you want to look at. One thing that I do want to show you, and this is moving, this is brand new with the live charts, etc. The beta form, you can access it at hub.com or go to that link. But we do have the legacy software, so we're waiting on Refinitiv to put in the crypto data, and they tell us it's going to be here every day, every day, every day. We all know what's going on in the crypto world. So I thought I would show a chart of Bitcoin and Ethereum for you real quickly as well. But I also wanted to show the dollar, and you can see that this movement higher in the dollar here is not positive for the bottom line. We're a global economy now. All companies are trading around the world, and it hurts the exchange rate. So we're going to see that reflected if this dollar keeps going in the next quarterly earnings. It's too soon for it to show up this quarter as we just moved into earnings season. But next quarter, if the dollar stays strong, that's going to be difficult on the bottom line of companies with international exposure. We are a little bit above the 10-day moving average here on the dollar. It surprises me. We can talk all we want about how much debt that we have in the U.S. And how much debt we're continuing to issue. It costs us $1 trillion now every 100 days in order to service our debt, which is insane. But that's where we are. But as long as other countries are buying the dollar and view it as the currency of last resort, we're going to continue to issue that debt, in my opinion. But I would really hate to see the dollar move too much higher. And with that wave 5 up there at 108, that's a little concerning. But we have a lot of congestion here around the September-October timeframe as far as potential resistance. So maybe the dollar calms down, maybe interest rates calm down, maybe we get a little reflex bounce in the markets. And you all know that the halving is coming up on Bitcoin. We had this big run, and we've been trading in a trading range ever since then. Basically, rounded off between 60 and 70,000, but 60 to 72, and that happens over the next few days. Forecasts are 19th or 20th of April. I don't think anybody knows the exact time that it's going to happen, but we've gone through some consolidation here. And if you're not familiar with that means, the amount of Bitcoin will be cut in half, hence the halving. And so we've just kind of been trading in a range since this earlier run up. This will be the 4th time it's occurred. All the previous 3 times we had a run up into it. So we did this time as well. And then usually what happens, since you're cutting supply, it goes back to supply demand. The expectations would be that perhaps you get a run again once that occurs, if you believe in the supply demand curve. So Ethereum, same thing. It's another one that a lot of people look at. A bit more of a descending triangle here, not so much a sideways corrective move as we had in Bitcoin, but we're down here around support. We also have a 5-wave pattern here. I think Ethereum is going to go with Bitcoin. A lot of people, I'm not the greatest crypto expert in the world, but one of the things that I like to do for our subscribers, if I don't feel that I have great confidence in my ability in an area, then I'm going to go find the person that does. And so I have some who I regard as real crypto experts that I refer to. We do a show on Fridays regarding cryptos, and we want to make sure that we're getting the best information out to you that we can. And from what their feeling is, Ethereum is going to outperform Bitcoin following this halving. So I wanted to show you that. Another thing here is, even though it's in a descending triangle, regardless of what you may read out on the internet, a descending triangle does not mean it's going to break to the downside, no more than an ascending triangle means you're going to break to the upside. I've done a lot of work with triangles and the strangles, and again, the book and et cetera. I feel like I know as much about these consolidating triangles as anyone. And I can tell you the data shows that they can break either direction. So we have a trading range in Bitcoin. Something's probably going to happen after the halving. We have a descending triangle here in Ethereum. That's going to break out. We could go sideways here a little bit longer and move further into the point of the triangle. But these are showing you in Bitcoin world that something is going to be happening here in the not too distant future. So keep an eye on those areas if those are something that you're looking for. So there is the link again for the free offer. And again, you get all the alerts for the directional trades, the triangles, everything that I've talked about. We send out entry and exit signals, not just entries and then you're on your own. So we also give you guidelines on when to get out based on what the AI tells us. Again, we don't want your credit card information. We're not asking for that. You can decide after your 30-day free trial if you want to continue to participate. But there's the link again. Oh, I see David posted it. So yeah, so there's the link, home.ewotrader.com/ewo-AI-trial. And that'll give you not only access to this live Wave software, but also the alerts. And we send them out via SMS and email, so we will need your phone number and your email address. But I'm not going to call and market you. Not that, we just need to know what your phone number is so that we can send you out the text alerts, and your email address as well. But not credit card information. So that's how you can take be interested in looking at. One of the things that I get asked about a lot is Amazon. I think we all kind of want to know what's going to happen with Amazon. and you can see that it's been a bit of a stalwart, moving higher after this earnings report. It took off. It's below its 10-day moving average, but well above the 50-day moving average. The DMI is kind of showing that we're getting a little tired here. So maybe that big part of that run is over. It was one heck of a run, no doubt, in Amazon. So maybe a little caution here. Makes me nervous that we have this gap back down here. I hate it when that happens, but we gapped up and took off. Someday that gap will likely get filled, but it doesn't necessarily mean it's going to get filled immediately. Again, it could be later rather than sooner. But that move there was fairly strong. The ADX stayed horizontal. It doesn't do that a lot. So when it does that, it tells you that all of this move was equally as strong. And normally when you move up like this, the higher it goes, the weaker it gets. Like you get into thin air, like a rocket going up, the air starts to get thinner. But this was a pretty strong move to the upside here. But it does look like it wants to take a bit of a pause. Amazon, maybe a little bit of a market rotation, et cetera, is in order here for Amazon to continue or not. A lot of people ask about Coinbase. That kind of goes along the lines of what's happening with Bitcoin. Obviously, you can see we've had a nice correction, and there's that triangle that I've talked about, these triangles. So we had a really nice symmetrical triangle, and there was the downside breakout of the triangle on Coinbase. So at this point in time, we may have the opportunity for a bit of a bounce. It looks like we're in an area that could hold right in through here. So that wave 4 is right at the 38.2% fib corrective level. I would submit that if Coinbase can't hold here, then yikes, we're probably coming down into this area. So that was the highs back at the end of the year. It's right around the 38.2% level, as I said. So this will be an area that perhaps we can hold. We're oversold from the 10-day moving average. So we'll see if that can mount some sort of a bounce, staying kind of in the same realm here that a lot of people ask about, and it's all tied into Bitcoin MicroStrategy. And I'm sure everybody's aware that they are more of a Bitcoin play than anything else now. They issued a debt offering to buy more Bitcoin. You don't hear of companies doing stuff like that very often. But once again, we had the triangle formation here, a downside breakout as Bitcoin corrected over the weekend, moved down about $10,000 over the weekend. But again, my experts tell me that a pullback is normal going into the halving. So none of those people are concerned. And if we do start to get a turn back up after the halving with Bitcoin, then I think MicroStrategy could take off again. Look, we're right at a 50% correction level here with MicroStrategy. And if it's going to hold, this would be a likely area for it to hold. It is just a touch oversold here from the 10-day moving average. You can see where we're trading here and the 10-day moving average. So even if it's just a reflex bounce in MicroStrategy, that's likely. They have an earnings report coming up, and their last earnings report was back in here before this big run up, but it was also before the big run up in Bitcoin. So you would think that they're going to come in and put in some pretty decent numbers. At least that's what I would expect for MicroStrategy. But maybe that's baked into the cake after the big run. And the expectations are certainly going to be pretty high for it. But once again, on the short term, you might see a little bit of a reflex bounce here on MicroStrategy after the halving, if Bitcoin does turn and move back to the upside, and then at least in anticipation of the earnings report, maybe not moving through the earnings. So I also want to show you that we also have a community aspect here, which is really cool about this software. You can come in and post your own ideas, very similar to Reddit, whatever. You post your own ideas and other people can vote. So all the other users can come in and vote on your idea, and it gives you a ranking, consensus of opinion, and then it says how you're doing. How often have you been right? How often have you been wrong? Etc. So all those things are available here. So there's a huge community aspect here in the software, in addition to all the charting, etc., and getting live intraday charts from Elliott Wave, which is just amazing to me to have that. But you can come in and vote on any of these. You can post your own. You don't have to post an idea. You can vote on other people's ideas, click on them, see what they're saying, and whether or not you agree with it or not. So there's a bunch of different themes that you can go through and look at for your favorite sector, etc. All that stuff is available on this platform. So you can see we'll have pure fundamentals coming soon, but all the technicals are there for the charting that you can take a look at right now. So I thought go ahead as we finish up here and take one last look at the SPY and see what we're doing here on an intraday basis as we've been chatting. So there's the daily chart, and over here on the left-hand side, you can go longer if you like to look at weekly charts, etc. There's the 3-minute chart, and we'll see the market was trying to bounce a little bit when we showed the previous 3-minute chart. So you can see that, yeah, that bounce ended. So it was short-lived. And then we have headed back down a little bit. And as I pointed out, we did have where it looked like we may go a little bit lower. So we had the wave 4 bounce here, and perhaps we may head lower from there. Now, the one thing is that this wave 4 rebounded 84%. That violates the Elliott wave pattern. So from an intraday standpoint, you would take that off. You wouldn't look at that. So from here, we could consolidate anywhere within this area. I think if I was trading on an intraday basis, I would have been a little bit disappointed that we didn't hold this area here when we got back above 502.5. Would have liked to have seen that hold, but it didn't hold. And so with that, we may just kind of move into a training range moving into the end of the day. So that's what I wanted to share with everybody. One last thing here, David, as we wrap things up, I'll just go ahead and move to weekly chart because I think that's been interesting. We needed to have a little bit of a correction here on the weekly chart, and it looks like we're starting to have that. So I think that's important moving forward here if we're going to continue the momentum. So thanks for having me. Thanks for listening, everybody. Appreciate the questions. Hopefully, everybody's taking advantage of the free offer, and let's take this AI stuff where we all think it's going to be. I think if you're not using AI, you're going to be left behind, and we feel like we're one of the front runners with a over 7-month track record of actual application and actual alerts going out. So interesting times. Watch for that PCE report. It's going to be a market mover.